Good Tuesday, election day morning, chameleons. Everyone joining us for the first time. Thanks for stopping by the Market Chameleon pre-market show with the main man, Chief Chameleon, all the way from the city of brotherly love, Dimitri Pagamarnik. How you doing, D?
Good morning, Will. How are you?
Am I sharing the right screen?
I think you just have to expand it.
There you go. It's up for everyone to see.
All right. So I think you still have to expand it, Will, but it's
All
there.
right. It's expanded on mine. I don't know if I can get it any bigger.
All right. Well, good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice and provide you with guidance. There's the disclaimer.
All righty.
Let's get started.
What are you seeing in the pre-market?
Yep, let me share my screen. And before we get started, I'd like to mention we are doing a webinar today with Interactive Brokers at 2 p.m. this afternoon, 2 p.m. Eastern. And I'll talk about, we'll discuss basically stock volume profile. And a lot of people just look at volume in aggregate. Was it unusual volume? How, was it more than usual, less than usual? And when we talk about, and this is stock volume, I'm going to focus today on equity volume, not just option volume, because we do have discussed option volume in the past, and probably I'll get into that more. This will be equity volume, and it's going to break it down, and I think in ways people don't usually think of it that way. People usually think of, stock volume, but stock volume is not all the same. And there are a lot of things going on there in the stock volume that normally people don't look at. Venues, different venues, there are dark pools and lit exchanges, there are large block trades, there are small trades, there are contingent trades, there are sweep trades, there are different trading, there are different trading conditions, there are different actual trading sessions. We're going to discuss that and what kind of insights you could get from that volume. And that will be at 2 p.m. today with Interactive Brokers. You do have to register with Interactive Brokers to see that, because they are hosting it. We're not the ones that are broadcasting it. It's within Interactive Brokers community. So they're holding it. We do provide a link to register. It's free, but you do have to register with them to view that webinar.
Yeah,
right,
and I popped that link in the chat.
Okay. So having said that, today, anyone has a question out there, if you could put that on the live chat. Will's watching it, he'll read it back to me. It could be questions on Market Chameleon tools, data analytics, strategies, things you've seen out there and you'd like to share with the community. You could put that either on the live chat. We also provide a link to Zoom, and if you click on that link, it takes you over to Zoom. When you're in Zoom, if you click raise your hand, that gives us an indicator somebody wants to come on a show live. It'll prompt you to turn on your video camera. You don't have to do that. Once you're in there, everybody could hear you, could ask your question directly. Those are the two ways to ask questions. While we're waiting for questions to come in, what I'll do is take a look at the pre-market report. We'll see what's trading the pre-market hours. And then maybe I'll go to the options chain and set up some option strategies to take a look at how you could structure an option strategy based on certain outlooks. Okay, so we'll create a couple different outlooks, and then just using the options chain, we'll see if we could use multi-leg trades to create a strategy, and we'll take a look at that payout diagram. All right, so sound good, Will?
Yeah, we did get a chime in from Laurent this morning, and I don't think Laurent was on live yesterday, but he was mentioning your show about basically this dispersion strategy and
Yep.
describe it as a volatility pairs trading, which is an interesting description.
Exactly. Yeah, we went over that yesterday, and it's kind of like that. You could think of it as a pairs, except it's more of a basket of different stocks versus usually an index, right? So look at it as SPY index versus a basket of components that are correlated to that index, and it could be in the dispersion. The way I showed it yesterday was buying options, buying gamma, buying vega in components, and financing some of that by selling the vega and the options in the index, with the idea that dispersion, any stock could move around up, down, and then the actual index may stay steady. And if that happens, and that happened last week, that could be profitable. Of course, you'd have to run that and set that up through your model. But I just kind of presented that strategy and idea to get you guys thinking.
Yeah, it was great. Actually, Laurent also thanked you for answering his question. I think that was Friday. He answered his question, and he was able to watch it. So.
Okay. Yeah. Well, thank you for bringing the question on. Let's do, let's do the pre-market report first. If there are questions, stop me, Will. If there aren't questions, I'm going to go to the options chain.
All right, perfect.
All right. So pre-market report, and these are stocks that are trading in pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. And by the way, I will be talking about pre-market hours as well today as part of the equity volume profile at 2:00. But right now, we're just going to do a quick rundown. What's going on in pre-market? And we come down here on our percentage gainers list. I see 72 stocks on our percentage gainers list, 62 on our biggest percentage decliners list. From this perspective, we're looking like a slightly bullish bias at the open. I'm going to filter down this list to only S&P 500 stocks. So we're going to take out low cap stocks, ETFs, leverage products, closed-end funds, preferreds, rights, units, all those, taking them out to focus only on S&P 500 companies. And I'm going to use this filter up here in ETF. When you drop it down, get to select from different ETFs. Let's say we're going to take SPY, the S&P 500 ETF, and click on it. That will filter out the list below by holdings, stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And we see here 14 stocks made our percentage gainers list, 4 in the decliners. From this perspective, we are looking like a more bullish bias at the open. And of course, we have elections today. And I think the thesis behind the elections is, if we get a divided government, if we get divided House or Senate, if we get a divided government, it's harder to push any type of big agendas through. And if you can't push stuff through, that means that there are no big changes on the horizon, and the markets don't like uncertainty. So if there's less uncertainty about any kind of big changes, that could benefit the markets by taking that uncertainty out. So right now, the assumption is that the markets are looking at it and saying, well, that might happen. We'll see tomorrow. But if that happens, that could take out some uncertainty regarding, any type of big legislative changes on the horizon. Okay. Let me see if there are no questions. Maybe I'll just move on to the option chain.
Perfect.
Yeah. Okay. Let's go to, I'm going to go to SPY. That's just my default stock to go to do demonstrations. But we'll take a look at the SPY options chain, and I'll give you some alternatives to doing a strategy using options. And when in finance, when you do an analysis, a lot of times you will do analysis either on the valuation of a company or an outlook in a stock, and you're going to create a range of possibilities. Okay, so it's never if you're working with models, if you're working with estimates, you're working with forecasts, it's usually in ranges, a range of probabilities that something is going to be between here and here. So in a stock price, you might come up with a base, then you come up with an optimistic scenario, you come up with a pessimistic scenario. You could give them different probabilities of reaching, but it's not always like when you hear analysts, right? And a lot of times analysts will just stick at a price, target price, $50. But how do you figure out an exact price like that? Nothing's exact. There's no inputs that are exact to even come up with a price like that, because you're dealing with lots of different estimates, whether you're trying to discount future cash flows or earnings, or even using some kind of relative valuations. You have standard errors and so forth. So usually you're dealing with ranges. You can't just say here's the exact price like an analyst will say, and that's it. And given those outlooks, if you could start modeling out those outlooks, then you could look at the options chain and come up with strategies that kind of fit within those ranges, right? If you say, I think the stock's going to be between here and here, or there's a higher probability it'll go up, and there's a probability it'll go down, and if it goes down, I think this, in the next 30 days, could go down to here, up to here. Here's the base price. All right, and that's kind of like when you start thinking that that way, you could expand the strategies that you employ, because a lot of times what you'll see is people will think, I'm going to come out here to December just to give it some more days, 37 days. And what I see a lot of times, people think it's either going up or down, right? So if it's going up, I'm going to buy calls. If it's going down, I'm going to buy puts. And but you could think of it, well, I think it could go be between here or here, or more likely to go up, like we're talking about. One of the strategies people do are buy rates, and sometimes I see people just actually talk about putting on a buy rate. That means they don't really even own the stock, but the volatility or the premium might look good, right? Like here, let's say in SPY, well, wow, these calls look really good at $9 or $3.95. These calls at $7.25 look really good. That's a lot of premium, and my target is that it could go to $3.95 between now and December. Historically, let's just say there's seasonality drift. We see here 37-day out. Seasonality, historically, 83% of the time, market drifts higher, right? For an average gain of 1.8%. And in a 37-day period, historically, the market also drifted higher. So we're kind of, let's just say for now, we use those numbers. And if your assumption is, I think it's more likely to drift higher, and let's just ignore like interest rates for now, all this stuff going on. Let's say you think that it's going to drift higher. You're willing to buy the stock, but you don't think it's going to explode to the upside between now and December, and you're willing to do the buy rate. So let's just take a look how that would look. Which ones did I say here? 395. So you're selling the 725 strike. So you're bringing in that premium, right? $7.25. And you're buying 100 shares stock. So this is how it would look, right? You're basically, if this looks familiar to you, you're selling a synthetic put, right? Because a put would look like this, right? You sell a put, stock drifts higher, you keep the premium. If it goes lower, you're going to lose all the way down. So look, I'm going to expand it 20%. So it looks like a synthetic put. But the idea is here, well, I just think it's going to drift higher, and that the vols are high, right? You wouldn't be selling if you didn't think the vol was high. The premium is good, and that looks like a good strategy to you. And that's your outlook right here. That's your sweet spot, 395 or whatever. What was it? I saw 395 strike. But I do have this downside. Maybe there's a way to say, okay, how do maybe I want to do the buy right, but I want to protect myself here. So there are a couple different ways to do it. You could do it as a call spread, or you could also do it as a diagonal. So we haven't done diagonals, and I'm going to give you an example of diagonal. So I'm taking this out of here. I'm going to say back to 0, right? Now we have a naked call, right? Naked call, but that's not the way we want to go. Bring it in 725. And let's say I don't really even want to hold it to December. I just think December is pretty, far away. And I think that it's either going to drift the rest of November, or it could go down. So if it drifts the rest of November closer to 395, then I don't mind this strategy. I'll even convert it to stock. So let's do this. I'm going to go to November 30th. And let's say I pick a different strike to say that 372. I'm going to buy, instead of buying the stock, I'm going to buy an option. Okay. So 372 call, I'm buying this for 1407. So you could see now I'm doing a diagonal. I'm buying the November 30th 372 call, selling the December 30th 395 call. So load that strategy. And I'm bringing in 668. So I'm sorry, I'm not bringing it. It's costing me $6.82 on the offer, 668 on the midpoint. So this graph here is using the offer. And here, this is right now drawing the payout diagram on November 30th expiration. So once November 30th expiration comes up, this strategy will be over. So you have to decide, do you want to take off that leg, or do you want to go out and buy another call or buy the stock? But what it does here is that you see from here till November 30th, if the stock crashes, right, you're kind of limited now to your risk, right? You don't have, it's not just like going all the way down like you would on a buy right, because sometimes you get caught on these buy rights, and what happens is the stock's down 20%, 15%, something happens, and then you're like, oh, well, now I have to hold on to this stock, hoping that it starts climbing back up. Here, you're kind of stopped out. And look at this. And for a second, just look at the risk reward ratio, right? Given these, this is assuming that the implied volatility is at the same place as it originally was, and it's also, assuming November 30th expiration, and it's taken into account the decay in the December 30th call, right? But look at how you change your risk reward here. If the stock does rally, So what happens? The stock rallies is just like it's kind of like the buy right, because right, you own the call, that's going up, but you did sell an upside call. So you're going to be stopped out at some point to the upside. But according to this, right, your risk 682 to make 1,504. So you see how just using the options instead of the buy rate where, your risk is all the way down, it's hard to, calculate because you'd have to put in a shock, potentially 10%, 15, 20%. Now now you hedged off some of that downside risk. And given this scenario, you got like better than 2-to-1, right? Payoff. So that's just a different way of kind of looking at that outlook, right? Looking at the potential outlook. Okay, I think either we're going to drift higher. This would be, I think we're going to drift higher and implied vols are going to come in, things are going to decay. But if we don't drift higher, on the other, anything could happen. We could have a shock. There could be another, something happened in Ukraine, the war, inflation numbers could be bad. We got another, and maybe the Fed will not start putting on the brakes on interest rates. They might have to continue to be aggressive. That could create a shock. And I don't want to take that shock risk and limit myself. That's a different way of looking at it, right? Looking at your not only potential upside, but what is your potential downside in that strategy. So this is, a different way of looking at it. But then let's just take a look at it from a historical perspective, because we are doing a diagonal spread. And there are a couple different relationships going on here, because now we are doing options on two different expirations with different implied volatilities, right? So now we got what we call a horizontal spread going on, because there's a skew going on a term structure, right? So the term structure, you don't always have the same implied volatility. You'll have a different implied volatility slope. And we also have different strikes. So one strike is above, it's an upside call. One strike is below the spot price, so it's an in the money call. So that's also now you got a vertical skew at the same time. So the diagonal spread here, it has a couple different things going on. And what is the relationship usually between two options that look similar, right? So how do these two options usually get priced versus each other? Because you got two different premiums going on. So let's take a look here on the IBKR. This is where the IBKR can help us. And it says, looks historically at, the benchmark options, what option 1 versus option 2 would be, right? And then it creates a daily Theo going back in time. And here it says, on average, this spread traded at, on average, price at $8.34. That's the average. Although you see on the high end, 1086, low end 174, but the average 834. Now it's 682. So theoretically, if we use 4 years of data, we're below that average price. Let's go back to 1 year, because this is where Lauren was saying, what about the most recent data? So now I'm going back. So now I'm at 1 year. So these tightened up, the low and high did tighten up, but the average still at 832, we're at 682. So in theory, we're getting a good deal, right? Usually a similar spread on average traded higher in SPY than we are at right now. So if, things just reverted back to the average today, then we're looking at what, $1.50 in theoretical edge, right? Difference between the average and the market price. So I'm right up at 9:30, Will. I was going to show a different, another type of setup, but I think that will be it for today.
Yeah, that's perfect. And everyone remember, I'll put the link in again, but Dee's doing a webinar today with Interactive Broker from Interactive Broker Studios. That's at 2 p.m. Also, Lauren reminded me of something that's going to be interesting today. That CPI number comes out on, I think, Thursday. Maybe something we want to look at, maybe what the straddled SPY is implying for this week or something like that. He's thinking about going into all cash, he said, going into the CPI report. So that's interesting.
Okay. Sounds good. So, yeah, so we'll take a look at that, maybe tomorrow. And again, 2:00 today, you guys want to hear the discussion of stock volume profile. That will be with Interactive Brokers. We'll put out a link there.
Awesome. Remember, get out and vote, everyone. Thanks, Dee.
Yep. Thanks, everyone. Stay safe out there. Have a good trading day. Hope to see you guys later.
Trading.